So I'm going to do this lecture in parts because the material is somewhat complex. Some of you might have not been exposed to it, and it might be a different way of thinking about things. So we're going to start off. The question for this part of the lecture is, what is money? And I'm going to do this in shorter segments. So we'll do this compartmentalized a little bit. There's quite a bit of material this week, although I'm not going to give you much reading. It's going to be mostly listening to me, and then I'll provide some study guides along with it. So in this section, I want to start thinking about the financial system. So up till now, we've been doing mostly microeconomics. Now we're going to do some background for the financial aspect and think about where businesses fit into this financial system that's out there. And to kind of give you an idea of how this system operates, and whereas Dr. Harris will be kind of covering the nitty-gritty and some of the formulation of things, I want to give you a sort of an overview of how it operates and how you might think about it. And in some ways, I think this section is a bridge between the economics and the finance. But hopefully, it'll give you context for what Dr. Harris is doing, because I'm going to look at the building blocks of the financial system, and he's going to look at the operation of it much more so. So we'll look at the roles and function of money. There's a section in Krugman on this. I'm going to probably go beyond it a little bit, but it's well written and certainly decipherable on that. And you might want to read that as well. But I think you can get most of it from what I'm going to cover here. And then introduce you to the concept of liquidity. That's just how the ease with which something can be turned into purchasing power. But that's really the quality of money that we're really after. And oftentimes when we're talking about how much money is in the system, what we're really after is how much liquidity is in the system. We'll look at types of money just to get a feel for different things that have served as money and different aspects of money. We'll look at briefly definitions of money. Textbooks, I think even Krugman spends a lot of reasonable time on this. I think it's a little bit mind-numbing, so I'm going to make a quick distinction, kind of show it to you just so that you're aware of it, but it's not something I want you to memorize in any sense. Introduce you to one of the older theories of money that still is around, called the quantity theory of money, and how 2008 put some shockwaves into this. And then look at some alternative theories of money, and then ask the question: is Bitcoin money, and to what extent is it money that's out there? Address the idea of endogeneity, and by that I mean how much does the Fed control the money supply, and how much of it is endogenously produced. So we do know there are two periods in which the Fed tried to do something and tried to either expand the money or cut the money supply, and it didn't quite work out as they might have planned on that. So is money, instead of being something that the Fed can exogenously control, it's something that's really endogenous to the system, created through the banking systems, through the private system, through shadow banks, through all sorts of things that are out there. And then I'll sort of conclude with thinking of our system as a hybrid system, and I'll also sort of introduce the concept of a monetary hierarchy that comes from Hyman Minsky through Perry Meerling and some other contemporary thinkers on this. And then leave you with the concept that one of the things that is often left out of textbooks, even often left out of finance classes, is this idea that liquidity is not free. And we saw that a few weeks ago, that liquidity is something that is critical to the system. And every now and then we have problems associated with it. And we have to come to terms with it, that there's a whole process of providing liquidity to the system, and it is priced. There is a cost associated with it. Okay, so let's start out with, let me see if I can get this to, there we go. So one of the ways of thinking of the financial system and thinking of businesses within it is to think of it as an interconnected series of balance sheets between households, between businesses, between banks, and even between the government. And so this sort of linkage between assets, those are the uses of funds, they're things that you own, and liabilities, which are the sources of funds, so where you get your funding from in various ways that are out there. And we can think of all of these as being interconnected, and that, you know, one agent's asset is another agent's liability. And we have to think that when we're creating something, that it's usually going to have an asset quality to it and a liability quality to it at the same time. And we're actually going to see the same thing is usually true for money, okay? Maybe even always true. That's a debate over it on that. But when we look at this, if we look at the asset side, these are, you know, you get cash inflows, and this is what you do with your funds. If we're thinking of a household, probably the biggest asset on most households' balance sheets is their home. And of course, at some point, they don't own all of the home. They might only own a portion of it because they haven't paid it off yet. Now, the interesting thing, if we're still on that household side, is on the liability side, you also have something related to related to housing, and that is the mortgage that most people carry. And so you have this interesting thing. Why was housing so important in 2008 and in the 1930s and in a lot of crises that we look at? It's because it makes such a huge proportion of people's balance sheets, both on their asset side and on their liability side, that are out there. So, and then there's also this concept of net worth, or sometimes called capital, or sometimes called equity. This is just assets minus liabilities. This is what you have to keep positive in order to be solvent and to not go into bankruptcy or foreclosure or any of those things that are out there. So this is what we're looking at when we're looking at whether we're looking at banks, whether we're looking at firms, whether we're looking at households, or even with the government, that they have a balance sheet with assets and liabilities. Sometimes they're the reverse with each other. So oftentimes the things that are assets to banks are liabilities to the Federal Reserve, and often things that to a business are liabilities are then assets to banks. And so we have to look at this interconnection between them. Now, again, thinking about that household, just to give us an idea of working with these, is that you can think of on that asset side holding a house. One of the problems with holding a house is it's at least in crisis situations, that is usually not a very liquid asset. It's not something that you can convert into purchasing power very quickly. So the fact that so many Americans had a balance sheet dominated by real estate made it so that they were liquidity poor. They weren't ready to get hit by any sort of shock, because they, you know, in a crisis, it would be hard to sell your house. Now, my wife and I, when we sold our last house to move into the one that we're currently in, it took us 1 day to sell our house. So sometimes housing is a liquid asset, but and in many cases it's not. And so that's what we're looking at. We're going to come back to this when we talk about banking, but keep this in mind that we're thinking of these interlocking balance sheets, assets and liabilities, and this is how we should understand the financial system. And we'll come back to this again and again and again. Just one last thing, we're thinking about the house. Well, I'll come back to it later, because we'll talk about crises a little bit later. Okay, so there are 2 survival constraints to keep in mind, and one of them is the liquidity constraint, and this is you need enough cash reserves or sources of credit to meet your current obligations. And so one source of problems that people can have is that they're not liquid enough. I just alluded to that. One of the problems that households faced going into the global financial crisis was because so much was in real estate, that they didn't have a significant chunk of money in liquidity. We saw a couple weeks ago that the problem for the banks and the problem for firms that were dependent on the banks was that the market for liquidity seized up. It had problems with it. It wasn't really a solvency issue. It was a liquidity issue. Now, banks and households and firms also face a solvency constraint. So do governments as well, but only in certain ways that we'll have to talk about. But so the solvency constraint is that assets must be greater than liabilities. For a bank, they have to keep bank capital positive. For a household, they have to keep assets greater than liabilities. So we have two survival constraints out there. One is a liquidity constraint, okay, and one is a solvency constraint. So the way this looks is that you might have plenty of assets and relative to your liabilities, but you may be in a situation in which you can't convert that into the purchasing power that you need at that moment, and that creates a liquidity problem for you. You might also be in a situation in which your assets don't meet your obligations that you have and those liabilities that are out there, and that's a solvency issue. I think there was a debate during the financial crisis as to whether or not this was a solvency crisis or liquidity crisis. In my estimation, which is of course right, but no, in my estimation, it was both, that there were some severe liquidity. In fact, it started as a liquidity crisis, and then there was some so-called solvency crisis, and then the Fed stepped in to quell first the liquidity and then some of the solvency issues with the buying up of a lot of those troubled assets in the TARP, the Troubled Asset Relief Program. Okay, so now there are lots of things as we shift towards thinking about money. There are lots of things that have served as money over time. There's even a development of money over time. So these are, there's always the idea that there's a reference point to barter. That's the exchange of goods for goods. There's a huge debate amongst economic anthropologists and anthropologists in general as to whether or not the origins of money come from barter. That's a story that is traced back to Karl Menger. It's certainly a good analytical story. Whether or not it is a good historical story is something that the predominance of anthropologists kind of say no, that money has existed way back, and you have monetary societies collapsing into barter, and you have it's just a much more complex picture than this nice sort of clear-cut step from exchange from goods for goods to money that's out there. We also have commodity money. This is money that has intrinsic value separate from it being money. So cigarettes in World War II POW camps were often used as a currency, and that was a commodity money. It had value to the participants separate from it being money. We often think of various precious metals, gold being predominant, as being commodity money. It has value outside of it being money, although I will say that a large proportion of gold's value comes from its money-like qualities and not its non-money-like qualities that are out there. And then we have paper money that is sometimes representative of precious metals. So we have silver certificates and gold certificates. These, the idea was if you had these, you could go to the treasury and ask them for a certain quantity of gold related to this at some point. So it was money that was backed by a certain amount of gold. I think you would get a pretty cold stare if you showed up with these today and tried to get your gold from that $20 note or $10 note that's out there. And then fiat money. Fiat money is money that is not backed by anything really, except for either the authority of the government or the economic will of the government on that in some respects. And this is an example of this is the greenbacks that were issued during the Civil War. Modern money after 1973, modern US dollars are really fiat money. It's money by fiat, nothing really backs it. And so it is money in and of itself. Why is it money? Well, we'll get into that in a bit. And then, of course, we've evolved into using checks. That seems pretty old now, but we're still using checks, quite a few of them. We use credit cards as a way we pay for things. We'll talk a little bit about whether or not credit and money are opposites, as some textbooks put it, or actually two sides of the same coin, so to speak, on this. And then, of course, we use debit cards, electronic funds transfers, stored value cards. The volume of things on stored value cards is amazing. I was reading an article about just how much money Starbucks was making because of their stored valued cards. And this is, what is this? It's kind of like a consumer loan to Starbucks that's out there. And this is in the billions of dollars. So for all of you out there with stored value Starbucks cards, I'm glad you're making a nice loan to Starbucks because they really need it. There's also e-money, there's Apple Cash, and then there's Bitcoins, and sort of the cryptocurrency. We'll talk about that a little bit later. And then there's the new one on the block, Facebook's Libra. This is really, it's both has some potential and it's running into some huge roadblocks. Particularly governments are reacting rather strongly to the idea of Libra coming in. So we'll discuss this probably not this week, but in next week when we start talking about the governmental role in all this. So there are all these functions of money. And this is, your textbook covers this, and most textbooks cover it. And I think, these are sort of necessary conditions for something to qualify as money. And there are three basic ones: medium of exchange, store of value, and unit of account. The medium of exchange function, I think most textbooks put that as the most important one. I'd probably disagree with that in this day and age. I think we could probably, there are lots of mediums of exchange, and there seems to be lots of different ways to pay for things. But what the source of this is that, if we go back, this is where the barter story kicks in, and why it's such a good analytical story. I'm just not sure it's a good historical story. That when you have sort of a simple society and goods are exchanging for goods, that works well if you have what I want and I have what you want, and that creates what's called the double coincidence of wants, and then we just exchange goods, and that works pretty well. But what if it gets more complex? Just to show you a diagram of this, suppose that we have all these people in society, and one person wants something from someone else, but then that person wants something from a third person who wants it from a fourth person. This is just a society, in this case, with just 6 people in it. When you start getting into the millions, you can see how complex it is. And so one of the roles of money is to overcome when you don't have a double coincidence of wants. It makes it much easier for exchange to take place. It's about efficiency gains. And clearly, money facilitates exchange. It makes things much easier. Makes it easier for us to buy a whole bunch of different things from different people, from different firms, all those sorts of things that are out there. I guess I couldn't imagine a society now that didn't use money for this, at least what we think of as traditional money on that, just because there's so many interlinks that we can do. There are even online barter systems that are out there. However, this is one of the functions. It also means that you need something that has a high degree of transferability, so you can move it from one person to another that's out there easily, and still maintain the value of it as it goes. Now that brings us to the second one that I think is something that is characteristic of a lot of things. So I think this is a necessary but not sufficient condition for something to be money, and that is that it has to be a store of value. It has to maintain its value over time. And so I know that during World War II, one of the first things that the combatants tried to do was to destabilize their monetary systems, because if they could create inflation and make a currency collapse, that would make the economy function much worse. And there was tremendous efforts to try to do this on both sides, more successful on the Allied side than the Axis side on that. But the store of value function is pretty important. I think what happens when this isn't the case is that whatever money is subject to a whole bunch of inflation, which starts to weed away that store of value function, then starts to face competitors for people storing their wealth. So you can imagine that in Venezuela, anybody with wealth is looking for some way to move that wealth outside of Venezuela. Same thing in Zimbabwe when they hit hyperinflation. Everyone's looking to put it into, say, the South African rand or euros or dollars in order to get away from it. This is a concept that's related to store of value. often referred to as Gresham's law, and it says that bad money drives out good. I don't like the term law in economics, but this one seems to work pretty well. It's, again, Gresham's law. I should write that down. I'll put that in the study guide. But Gresham's law is basically says that when you have two currencies circulating and one of them is losing their value, its value, it becomes like a hot potato. Nobody wants to store their wealth in it, and so they will immediately try to get rid of that particular currency and try to hold on to the one that is maintaining its value. So this has had all sorts of implications around the world. There's something called currency substitution, and that's when one currency starts functioning as the domestic currency. And we've seen places like Ecuador actually have to adopt the US dollar as their domestic currency because of currency substitution. When it's the dollar, it sometimes has a vernacular term called dollarization. And it can happen in a lot of places. And so in that case, they just decided to adopt it. So they don't have their own currency in that case. And that's because their currency had lost its store of value function. Okay, that brings us to unit of account. And this is the one I think is the most unique to money. And it sort of, to me, delineates the higher order monies from the lower order monies. And this comes from Keynes's treatise on money. It's not the general theory that most people have heard of, but it's this treatise on money. And the idea of this is that why is something money? It's because we quote prices in it. It's our standard of value. So we might have all these things that we use to pay for things, but our reference point is still the dollar. So when we walk into a store, everything's priced in dollars. I know that when I was down in Bonaire, one of the ABC islands, they would have, at the time, they had a dual standard, dual unit of account, because you'd have when you walked into a restaurant, everything was quoted in dollars and in Netherlands Antilles guilders. And everything had both prices because they were fixed against each other. But it was sort of a dual unit of account on that. But the unit of account is the standard of value. It's our reference point. And I think these days, the dollar is the unit of account for all unit of accounts. It's sort of the standard of value around the world. Other currencies are judged in relationship to the US dollar. Will that continue into the future? I mean, that's a question that we'll pose towards the end of this class as we get into currencies in much more detail. But for now, it's the central currency of world and international transactions, and so it is the reference point that's out there. Where does it get this from? Well, some economists argue that this is because you can actually, what determines the unit of account might be what they sort of have a phrase, that which we pay taxes with, that the government has a monopoly over what we pay taxes in if it has sort of the power to impose those taxes. And so this gives the dollar a leg up on every other currency that's out there in the US that's taking place at that time. So again, these are the functions of money. And so something is money if it satisfies these three functions that are out there. And I'm going to pause here. I'll come back and talk about liquidity, but I'm going to pause here and stop this video and then start another one later on this. I just want to break this up into pieces this time. So see you in a short bit.